Welcome to the Roetzel Health Law Hotspot. Health Law Hotspot is a podcast for physicians and health professionals that covers the legal issues and trends that affect the healthcare industry.
Hi, everyone. Welcome to the Health Law Hotspot. My name is Ericka Adler. I'm shareholder and leader of our health law practice at Roetzel and Christen. Thanks for joining us today. I'm joined by Christen Berman from Redwood Tax Strategy in Westlake Village, California. And today we're going to be talking about the employee retention tax credits. And I kind of feel like we're turning into a little bit of a tax podcast because we've done a couple of tax topics recently, but the employee retention tax credit is so important. And I've had so many questions about this lately. So let me tell you a little bit about Chris. She works with the Redwood Tax Strategy in Westlake, California, which is a national tax reduction planning firm, works directly with businesses as well as their CPAs to reduce taxes. And in particular, we're really interested in the employee retention tax credit, which Christen is going to tell us a little bit about, and which we know she's working both directly with businesses like physician practices, dental practices, and other types of practices, and as well, and I understand this is probably even a bigger piece of your practice, with those type of businesses, accountants who may be struggling to kind of work with their clients and aren't quite sure what to do with these type of tax credits. So welcome. Thanks for joining me today.
Thanks so much for having me.
And one of the first things I want to do is really find out what exactly is this employee retention tax credit?
Yeah, I think that sounds like a logical place to start, Ericka. So the employee retention tax credit, or acronyms could either be ERTC or ERC, is a COVID-related refundable tax credit. So what the IRS has done is they've provided this COVID-related tax credit really to reward those employers who maintained employees during the pandemic. So this will be applicable to the 2020 tax year and the first 3 quarters of 2021, and it is a payroll tax credit.
Okay, so how does this fit in with the PPP loans and the CARES Act money? Can you still apply if you already are using all your tax information to support those other pieces of funding that you might have received?
Yeah, that is a great question. And honestly, it's one of those areas that we find the most amount of dangerous misinformation out there. Because originally, when it was just the CARES Act, they originally said that if you got a PPP loan, you were not eligible for ERTC. But then the Rescue Act superseded that, and they relinquished that. And so now the bottom line is that even if you did get PPP loans, round 1 and or round 2, you are still eligible for the employee retention tax credit. Now, it's really important that you don't overlap like wages that you used for forgiveness for your PPP loans with your ERTC. And there's very important aspects to best practices for doing your PPP loan forgiveness application and coordinating that best to get the maximum ERTC benefit.
Okay, so let's say this is the first time you've heard about this and you're wondering, you kept people on the payroll during the pandemic. Do you qualify? Well, what should be the first step in terms of figuring that out?
That's another great question. So there's really 2 ways to qualify for the ERTC. So the real straightforward way, honestly, is to just look to see if you had a large enough reduction in your gross revenues. So everything's going to be compared to 2019 tax year as your reference year. So we pull the quarterly gross revenue for 2019 first, and then we compare each comparable quarter to what you did in 2019. So we'll look at 2020 and quarter 1 for 2020 compared to 2019. So for the qualification, the rules are different for 2020 versus 2021. So just based on the gross revenue test, if you had a 50% or more reduction per quarter from 2020 to 2019, then that automatically would qualify your business for the ERTC for 2020. Now, 2021, it is a 20% difference in your gross revenue for each quarter in 2021 as compared to 2019. So a very large difference in what you have to show based on gross revenues. So 50% reduction for 2020, 20% reduction for 2021 as compared to the comparable quarter in 2019. Now, if you don't meet those guidelines to qualify, the secondary test would be, was your business impacted by a government mandated full or partial shutdown order? And if so, did that mandate have at least a 10% marginal impact on your business in terms of revenue or the amount of employees or the amount of time that was allotted to your business? And so that's the secondary, and that's probably an area we should take a little bit deeper dive, because that's one of the biggest areas where we're seeing some misinformation and misapplication of the rules, is this business interruption test.
Okay, so let's talk about that. I mean, most, I'm sitting here in Illinois, but most states, I don't think all necessarily, had some type of mandate requiring a closing down. Now, some states did allow essential businesses to remain open. And since we're largely talking to medical practices, dental practices, some of them may have been considered essential. So this test may or may not work for all of them. But tell us a little bit more about it.
Yes, and how this business interruption test impacts the medical professionals is very important to understand. So absolutely, even essential businesses can qualify for the employee retention tax credit. And oftentimes it's going to be based upon the business interruption test. So what you really need to understand the difference is the difference between, was it a demand issue or was it a supply issue in terms of how your business was impacted? So the first thing you need to do is go to your state's website and Google the government mandated orders, because you need to keep that in your file if you're going to apply for the ERTC based on the business interruption test. And so the first thing you want to do is just see what government mandates were in effect that impacted my business, and make sure you make note of that. Then once you can confirm that your business was subject to a mandate order, partial or full, that's when you look to demonstrate the minimum of a 10% marginal impact on your business. So when I say it's important to understand, was this a demand versus a supply issue? Let's say we're talking about a physician's office. And let's just say that, yes, there was a government mandated order in place during a particular time, but they're an essential business, so they're still operating. So maybe they would normally do a certain type of business, such as a surgeon's office. Well, the government mandate may very well have said you can only do essential, critical surgeries now. You can't do any elective surgeries. So that government mandate absolutely impacted the what you could supply as a business owner. You were no longer permitted to do elective surgeries. So that would automatically qualify that physician's practice for ERTC benefits. And here's the interesting part: even if they did not experience a reduction in revenue, maybe they picked up other types of revenue, but still they were shut down in terms of being able to do elective surgeries. So that business would qualify. That's very similar to dental practices. Same thing with dental practices. You were not able to do cleanings because that wasn't essential. It wasn't critical. And so, but maybe they had so many dental emergencies that maybe their revenue didn't really show an impact, but their supply side, what they were able to do because of the mandate, was impacted by at least 10%. So they would qualify.
That's really interesting. So is this something that, a practice can go out and apply for on their own? Is this something that they need help with?
They definitely would want to seek help, and possibly their own CPA might be a good partner for that. That's probably where I would start, is just for them to speak to their own CPA. Honestly, at Redwood, because we work with other CPAs, generally speaking, we really went into this space thinking that we were going to just support our referral CPA partners and give them the tools. We've created some software tools to make sure that we're getting every penny that's due to the business owner and doing it safely. So we created software tools that we were providing to our CPA partners and then letting them take it from there. And honestly, leave it to the IRS to make things so complicated. And then, of course, they keep changing the rules. And then they've also scared the bejesus out of our CPAs by saying that this will be a high area of audit. So all of our CPA partners have pretty much said, we don't want to do it. We're going to just outsource it. So, but again, maybe your CPA feels comfortable doing it. And there are other businesses like Redwood that are there to help support them through it. But that's a good place to start, is your personal CPA.
And I've had some clients work with their accountants, and I know one of my partners, Donna Hartle, who's a tax lawyer, she
I
will.
know Donna, yes.
I know Donna, great. So she will work with clients and their accountants to kind of address this issue. The other, unfortunately, I have seen, some practices kind of go at it alone, only to then maybe realize that they got money that they weren't entitled to. And that's created a bit of an issue because, we've had to either refund or give back the money. And in some cases, it's actually impacted them. So I had a deal where a practice was looking to sell, and they had this money showing up as, as part of their bank account or their assets, however it was showing up at the time. And then they realized, oh no, this 600, 700,000, whatever it was, we actually have to give it back. So the financials we have are inaccurate, which was just kind of like a little extra issue that most people aren't going to have. But, you have to wonder who is out there applying for this. Do they know what they're doing? Do they know the risk they may be putting the practice at? And are they prepared to be audited or investigated? So I really do think that practices, and even if they have savvy COOs or CFOs, that they really do want to work with either a tax lawyer or a tax accountant or a company that specializes in this, just to double check the work, because it does seem the repercussions are pretty big. Now, one thing I know is this is a tax credit. Am I correct? So
you're correct.
You get money back from taxes you've already paid. Is that correct?
That's correct. Yes. And at the beginning, you could apply these credits towards future owed taxes, but that period of window is past. So now it's literally you're receiving a refund check from the IRS.
Okay. So it's not like you can pay less taxes in the future, kind of hold it as a credit, and then if I owe X amount, I just pay Y instead. It's not really working like that.
At this point in time, no, it's no longer working like that. And it's actually better for the consumer to get their credit up front now, because if we were to ask if we could still do that process where you apply it to future taxes owed, it would be spread out for too long of a period for it to be to the business owner's advantage. It's better to just now get it as a lump sum refund.
What happens if a practice has sold since they had their shutdown, or could they still be entitled to this?
That's actually an excellent question. So yes, whoever owned the business at the time of that this period applied to, that would be the person, the business that would be the entity that would be able to receive the credit. So this is very important. When you sell a business, did you just sell like the goods and the belongings of the business, or did you also transfer the EIN number of the business? So whoever owns the EIN number is entitled to the credit. So we have some instances where business owners sold their business, they did not transfer the EIN, and they were still eligible to receive the tax credit. Right. But if you transferred the EIN number when you sold the business, then it's the new business owner that's entitled to the tax credit.
Okay, great. And for most of my clients that are listening, and any practices that are listening, the difference would be a stock sale which is where the EIN transfers, versus an asset sale. And most of our deals are asset sales. I'll also warn you one other thing, that sometimes in some of these transactions, you do transfer the right to be entitled to any tax credits or refunds. So you do want to make sure you haven't given that right to the buyer before you do apply for the credit, or you're going to get it but not be able to keep it. So I think that's important. And I would guess that the liability for having done this properly stays with the FEI number as well. So if you applied, you got a tax credit, then you sold your business, and then you get audited down the road, there's going to be obviously some potential issues if it was done properly or not.
Yes, and the liability issue, honestly, is another really, really important issue for business owners to understand. Because as I mentioned earlier, we're finding that the majority of CPAs are not wanting to handle it, so they're outsourcing it. So they may be transferring the responsibility to a separate company. And let's just say one of the big areas is the payroll providers are pretty active in this space. Well, remember, payroll providers don't have all the information needed to properly do the ERTC. So what they're going to do is they're going to rely on the business owner to provide a lot of that information to them, and then they can file the amended 941Xs and help the business owner to file for the credit. Granted, a lot of the data that needs to be used to get the credit is payroll data. So it does seem to make sense that a payroll provider could be a good avenue to be able to help you with this credit. But in the area of the liability, it is not. If you've gone to a payroll provider, then it's really the business owner that the liability is going to fall upon, because you're the one giving the payroll provider all the information, and they're just literally plugging in, but they're telling you that you're providing us this, it's really your liability. So if in the event you get audited down the road, that could be a very expensive audit, because who are you going to turn to protect you in an audit? Your personal CPA, and they didn't do the numbers. So they're going to have to dig up, how did all this come about? Where did these numbers come from? And then there very well might be inaccuracies in the numbers if you didn't go through somebody very experienced in this area.
That's a great piece of advice. So we know there's some things to look out for, and we know that this is not necessarily hard to apply if you meet the criteria. Just got to get somebody good helping you. What kind of success are you seeing? Is virtually everybody getting some kind of credit here?
Well, at Redwood, we have a screening process. So as a managing director, if you're going to bring a business to the table to apply for the ERTC, we have written some software tools to be able to look at gross revenue information and then business interruption information, and essentially pre-qualify our businesses. So we're not going down this path of doing all this data collection, which is fairly extensive, until we know upfront that our businesses do qualify for the credit. And in our experience, the smallest refund we've gotten, and this was very unusual, was $20,000. That was a very small case. Almost all the cases are coming in $100,000 of refundable credit or above. And those honestly are not businesses even with a large number of employees, maybe 8-10 employees. So it's a very lucrative tax credit, and it's something that's really, really helping some businesses that struggled through the pandemic to survive. So I can't stress enough that this is something that I highly encourage business owners to pursue or investigate whether you could be a good candidate, and then just do it safely, with someone experienced in the field.
Right. Well, I think that's great advice. All right, so any final words? And we'll definitely share your information when we post this. So anybody has questions, they can definitely reach out and answer. But anything you can answer. Anything else you want everybody to kind of know about this?
Well, I guess I would say that understand that there's a lot of noise out there in this area, a lot of misinformation. One of the things that happened at the end of last year, at the end of 2021, and this, one of the reasons it happened, honestly, is very frustrating for those of us operating in this space. But they pulled Q4 of 2021. Originally, they said that the credit would apply for all of 2021. And honestly, they said that because so few businesses were applying for it, they felt it really, maybe they didn't need it. Businesses weren't in need of this. So they pulled Q4 of quarter four of 2021 because for multiple reasons, but a lot of it was they felt that there just wasn't enough demand to support it. Honestly, it's mostly because people don't know enough about it yet. And a lot of, because the CPAs aren't really wanting to do it, they would normally be the ones bringing the information to the business owners saying, hey, we got to file for this. So yes, quarter four went away for now for 2021, but the credit did not go away. And so many businesses are under the misinformation that it ended at 2021. And if you didn't file for it, that it's too late. Absolutely not true. So you're going to have the 3-year window from the time you filed your taxes to do amended tax returns. And that is your window to apply for the ERTC. So plenty of time still to be able to go back and look and see if this might benefit your business.
But don't wait too long, get it done, right?
Right. The sooner the better. And obviously we don't want to get anybody, waiting too long for their refunds too, as the IRS continues to get more and more backlog as we're getting into the new tax season. So yes, the sooner the better. If this has piqued your interest at all to wonder if you might qualify, it really only takes a couple calls to see if you are a good, candidate or not.
Great. All right. Well, thanks to Christen Berman for joining me today. And this has been the Health Law Hotspot, and I'm Ericka Adler from Roetzel and Andrus. You can check out more of our podcasts at ralaw.com and feel free to reach out with any questions. Thanks for joining us.
The Roetzel Health Law Hotspot is made available by the firm and its attorneys for educational purposes and to provide general information, not to provide specific legal advice. Use of the Roetzel Health Law Hotspot does not create an attorney-client relationship between you and the firm or any of its attorneys. The Roetzel Health Law Hotspot should not be used as a substitute for competent legal advice, and you should contact an attorney in your state about any legal needs or questions you may have.